Hello and welcome back to Darwin Investors. I'm Money Train Mike, and joining me today we've got Magic Mike. He's the other half of Darwin Investors. What we're going to do is we're going to talk about what we got right last week and what we maybe got wrong last week. We're going to be talking about inflation data, the possible the Fed meeting that's coming up on Wednesday. What are the possibilities going into that meeting and out of that meeting as far as the market is concerned? We're going to be looking at earnings that are coming up next week and ways that we're going to be actually taking like what we're going to do with our portfolio heading into these earnings and how we're either going to play them or not play them at all. We got some other things we're going to talk about. We're going to talk about Lucid Motors and Mobileye and just different things. And this is a show I think you want to stick around and hang out and check this out with us. How are you doing, Magic Mike?
I'm doing well. One of the things I'd like to tell our audience is that we have a varied experience in the market. I've been in the market for over 40 years. And so I've been through our major meltdowns and our great bull markets. And so I would like to share what I've learned and know. And I've definitely paid my dues. I've had times where I've lost 70% of my portfolio by not paying attention to some of the warning signals out there. So, so we're going to have perspectives of new and historical perspectives, and that'll be one of our goals throughout our videos.
Well, one of the stocks that we looked at last week as a stock that we wanted to look at was Restoration Hardware. And I was going to show people just what I did anyway last week with Restoration Hardware. If I look at, let me not share the screen here, but I go into my RH position from last week, and you can see what I did was based on the technical analysis and what we thought what we were going to do financially. I was able to get into the trade. I bought in on the 6th for $5.52 a share, and they had a really good earnings and sold out for $6.31 a share, and I made $2,700, or 14.5% in the course of 4 days. So if you stick along with us, we'll maybe hopefully try to guide you, and you can follow along with what we're doing, and maybe you can, if you want to, try and follow on with our trades, and maybe you'll be able to make some money as well. Again, we're not financial advisors, so to speak. I'm not telling anybody to do this. I just say what I'm going to do, and if you choose to follow along, that is on you. However, last week was a very good week for us. How did you do on RH? Did you get in on that?
Yeah, it was great. I have owned RH for several months, and when I first bought into RH, it was about an average of $535 in that range. And so when we recommended it, it was at about the 575 level, and it got as high as 640 after it reported, and then started to give back some of that money, ending up at about 603 for the period of time last week, starting with Thursday. It started to give back money because it was in a downtrend NASDAQ market. The NASDAQ took it down. If we had had an up market during that time, I'm pretty confident that Restoration would stayed at the 640 level on its way to 700. But at this point, I would continue to hang on to it. I wouldn't add any more to it. I'd see how it reacts over the next 2 weeks. Historically, a stock will tell you where it's going after about a 2-week period of time following the earnings report of a positive earnings report. It should trend up, and it can start trending up next week. But I would wait to get a confirmation that it's trending up before I'd add any more.
Yeah, one of the reasons I didn't add more into RH than I did was because I started to sell. I started to sell puts on it, because sometimes I'll look at something, I'll say, well, let me go ahead and sell a put on it. And when I went into this finviz.com, and well, basically what happened was they were going to give me a lot of money for these puts. It was like $65 out of the money. So what that means by selling a put is that if it falls below, I'm saying I will buy those shares. And usually when it's something as far out of the money, even when it's before earnings, you're generally not going to get $1,250, $65 or whatever out of the money. So I took a deeper dive here, looking at the stock screener, and what I found was, when I went into the retail consumers or consumer cyclical specialty retail area of the market, where RH is, I noticed that there was a lot of pain after earnings on a lot of these retailers. Let me go ahead and go to large cap first. These would be the companies we recognize. Not necessarily in the auto ones, but I noticed that, well, maybe O'Reilly went up, AutoZone went up, Best Buy, you see the large gap down on Best Buy. Now that was after a nice top and bottom line earnings beat. Ulta was an outlier. Ulta went up after earnings. Bath and Body Works went down and then sideways. But Williams-Sonoma got crushed after earnings. That's what made me a little bit nervous about RH, was because of the way that Williams-Sonoma behaved after their beat. They actually did on Williams-Sonoma, they did a top line beat of 3.5%, a bottom line of 6.8%. And their reward was essentially going from about $224 a share on down to now $171 a share. Now it's for a double beat. Dick's Sporting Goods, same thing. They had a double beat, and they've gone from $145 a share on down to whatever they are now, $113 a share, and so on and so on. Academy Sports, again, they might be actually they reported a while ago, and all of these are companies that have good valuations. 14 and a, where's Academy Sports? 14.5 PE, and so these are companies with Bath and Body Works is 12.8, Best Buy is at 10. So these are companies with nice valuations. However, they're taking a beating after reporting earnings, and so that made me a little bit gun shy about going all in on Restoration Hardware, because I was afraid they would get the Dick's Sporting Goods or the Best Buy treatment and gap down. And so for that, I did not sell that put, even though it was very tempting to do, because that was a lot of money. What's your take on why some of these specialty retailers might be going down? You know, your Dick's Sporting Goods and Best Buys and that.
Yeah, well, one of the things too, Mike, probably the premier name in all of this is Nike. And notice that Nike has been pretty flat for 6 months. It had one down dip back in September, where it dropped down to the 140 level, but it's pretty much hovered between 140 and 170 over 6 months. So the premier company really hasn't made any money. My opinion is that the supply chain really affects them. They have to pay more for what they get. They don't get what they need. And so the investing community is concerned about companies like them, Foot Locker, Nike, and all these specialty retailers. I really believe they're paying more for their goods. They're not getting the goods that they need, and that those two combined affect those retailers in terms of how much they make. And they're sort of stuck with raising prices. They really can't raise a sneaker like that sells for, say, 140 to 170 and expect to sell even more. So, but that's my thought. I think they're kind of trapped in trying to raise prices, and then they have some serious headwinds with the supply chain issues.
And I feel like that even though they provide guidance, well, some of these companies like a Dick's or a Williams-Sonoma, they're providing guidance showing that they're going to have a beat, or like Lululemon did, by the way. We'll come back to them. But like Lululemon did, they said we're going to have a beat. It's almost like people don't believe them, because I think we believe with the taper, there's going to be less liquidity, there's going to be less money rotating around in the market, there's going to be less money to go to stocks, there's going to be less money to go buy goods. And so even though they might be thinking that, hey, this is nice guidance, maybe they don't believe them. They think that they're going to actually, because the only reason why you would go down in price after announcing earnings is that analysts believe that your stock will be worth less next year than it is this year, despite the guidance. Lululemon, that was one that we were also into last week. Do you have any? What was your follow-up from that?
Well, I followed Lulu for a long time. Actually, as I may have said, we became familiar with Lululemon over 20 years ago in Vancouver, where they had some of their early stores, Victoria in Canada. Lulu was trading at the 460, 470 level in October, and then it started trending down in starting in mid-November, started trending down as the market started to get rough. And because it's a high PE, high growth kind of company, it began to lose steam. And it came out with excellent earnings. It beat estimates, but it went down. It went down from the 420s down into settling at 409 at the end of the day. But my thought is that its expectation, or the not so much the expectation, but the future in the mind of most investors is uncertain for Lululemon. I'm not really uncertain about it. Yes, it does have a high PE of 61, but most companies that are making money, it's making money, has money in the bank, has a terrific brand name, and has a big following, should do well in the future. And what I would do is wait for 2 weeks, let it settle down for 2 weeks. And if it doesn't drop below where it is and starts to maintain going back up, I would add to Lulu maybe about a half position that you would normally buy, and then wait a couple more weeks. I think it's going to have a very good Christmas. And Lulu's range for the past 52 weeks is in the 270 level to the 470 level. So actually 480 level. So I would give it some time. I wouldn't sell it if you bought it. That's my play on it.
Yeah, to me, it looks like it could hold the support here at 415. And if it breaks that support, the next leg down would be 385. So I guess if it can hold right where it is, like you said, don't add anything, watch it, see what happens, because it might have a break up to the 435 mark. And then your point on it does trade a little bit rich. That was the reason why I liked the setup a little bit. It was coming down into earnings, so I did buy a position in this, but I traded it a little bit differently. I'll show you what I did. But I like the setup a little bit, but again, I was concerned with the valuation, so I hedged a little bit my bet on this. But at the end of the day, I was like, well, it's a growth company, and let's face it, anecdotally, when I walk down the street and I see women, a lot of them are wearing these stretchy pants, and a lot of them are Lululemon. So I'm like, well, you know what? This seems to be the market leader, and they're expensive, and it's Lululemon Athleta, I think is the name of the company, Lululemon. What are they called? Yeah, Athletica. And Athletica is the other big brand. I guess you might be able to buy something that's called Athletica, and that would be a second brand that they sell. And you can see that I bought the shares at 425, 419, and again about 419 for 100 shares. And then I ended up selling out at 416 for a $510 loss just on the shares. But what I did was I hedged. And so I ended up exiting the position at a gain of $761. And what I did was I sold a put at 400, thinking that they wouldn't go below that. And that netted me $744. And selling a put, for I know you know, Mike, but I'll just say for the viewers, selling a put would mean that It's a bull play. Like basically, I think that Lululemon will stay above 400. If it goes below 400, I'll buy 100 shares of it. And so that's how I played that. But I was saying it will stay above 400. And this is when it was trading about 420. And so somebody paid me $7.44 for that. I eventually closed that position for $65. Oh no, excuse me, $55. $55. So I netted about just under about $690 on that. And then with 100 shares, I purposely sized my position up to 100 to sell a covered call on it. A covered call is a bearish play. So I have one bullish play and one bearish play. They didn't exactly seem like it makes sense. I did think that Lululemon would go up on earnings. I thought it would go up around $440, but just for that. So I sold one covered call on it for $600 or $599.33, and I bought it back for 15 bucks. So I made about $584 on that. So basically, so I hedged by selling one put, selling one call, and then was able to come out net positive on the position, even though I lost $500 on the shares. And that's how I chose to go ahead and play Lululemon. The one I did not play, did you play Costco, Mike?
I sure did.
Okay, now that was the one that I found to be a little bit scary, and I didn't enter into that one at all. And I should have. In hindsight, I was wrong, obviously. But how did you fare on that? Like,
well, I think first of all, for Costco, I think this is sort of like what Jim Cramer says about Apple. Don't trade it, just hang on to it. Costco generally reports and the stock falls. Generally, when it reports, the stock falls and it stays down for a week or two, and then it starts to recover. So that was my thought. So before it reported, I added 10% more to my position of Costco, which I've had basically off and on for 15 years. I bought it on the day that it reported, before it reported. I bought it down into the it was about 535 level, somewhere right around there.
mm-hmm.
And then, as you know, it closed at 558. So that was a nice move of about 7%. And so
Yeah.
what I did is one of my methodologies with buying stocks like this is that once it, first of all, because I was confident, I bought before it reported. Then after it reported and it bounced up and I saw that the market really liked what they saw, is I added half more of a full position. You know, a full position might be like if you're willing to spend $1. I added another 50 cents after it reported, after hours. And then now that we know its numbers, I will add another 50 cents worth, because what I've learned over the time is when companies have great earnings like Costco, is that they will move up about 1/3 of the total move before the next earnings report. So Costco's already moved up about 30% between now and the next 3 months. So there's, in my experience, there's 60% more upside in Costco from its reporting period. So I will continue to add Costco, but I will wait for any dips in Costco to add again. But the trend is up, the graph is up, statistically it's up, its earnings are up. And of course, anybody that is a shopper of Costco knows that Costco is a great company.
Yeah, it does tend to bounce off this 20-day as well. Let's see, it bounced and then it falls below, and then it follows a 20-day, and then it bounced. Now it hit the 20-day and then bounced up. For me, I didn't play Costco because well, it's not that I don't like the company. I love the company. It's just that for a consumer staple company to be trading at 50 times, it just scared me. Like I could see it where if a company like I don't mind Lulu doing it because of their growth rate and that. But with Costco, they've grown so much. I was scared to put money in it. So I actually let that one passed me by, and that was a mistake. I should have gotten into that one, obviously. So I'm definitely wrong there.
To me, this is one that you just buy and hold, and when it dips, you buy more. If you look at the Costco chart, go back 5 years, and Costco is trading 5 years ago at about $160.
Now,
So that is a tremendous move, 160 to 558 in a 5-year span. There's very few companies that have that kind of movement, and notice that there's very few dips in Costco over a 5-year period. And the last dip it had was when the market had that correction that everybody went down with.
well, it didn't go down that much. What was it? It was the end of 18. Okay, there it was. It was the China trade war, build a wall market, government shutdown.
It's had basically
interest rate rising and that sort of thing. With Jay Powell, he was in there. He was also, I think, raising interest rates at the same time there. It was just kind of like a perfect storm of garbage.
Yeah. December 2018 and March 2021 were the two dips in a 5-year period that amounted to anything.
And even in March, they didn't dip as much as other, because like I said, they're a consumer staple, and staples didn't take a beating that much during this thing. I mean, they were a pandemic winner, really, relative to the other stocks in the market. But because they're a staple, which is why I was a little bit gun shy to actually put that much money into it. But like I said, in hindsight, that turned out to be a mistake. Let's see. So sorry about that. Got some text messages in here, just kind of reading them. So we went ahead. Now let's talk a little about the inflation data that just popped up last Friday. Now the market actually rebounded on the inflation data. I have a theory why it might have bounced like that. And that's because the news was that the inflation was, the worst in 40 years. And it is year on year, it's the worst in 40 years. But if you look at it, if you go to the Bureau of Labor Statistics, for CPI data, and let me see here, download the HTML here, and you look at the numbers here. What we had was in October, the inflation data year over year was up 0.9 for all items, and in November it was 0.8. So it was actually declining there. But when I broke it down even further, I looked at, food at home, which is like, when I look at all these things, when you're looking at food, energy, commodities, vehicles, services, shelter, and all that bit. When I look at the ones that you need to have, I'm looking at food at home. I'm looking at basically fuel and oil, and I'm looking at shelter. These are the things you really need. You need food, fuel, and shelter. And if you add that up month over month, food at home came down 0.2. It's down 0.4 from September. When you look at fuel and oil, it was down, gosh, what is that? Almost 8 basis points, 7.8 basis points. It's actually down 0.4 from 2 months ago. And shelter looks like it stayed about the same. So it looks like we went from food at home being at, the inflation rate month on month being, 13.3, 13.8. We went from 13.8 to 0.8 plus 4.3. So 13.8 to 5.3. So we've cut the monthly inflation on the things that matter basically in half. So maybe they were looking at this particular month of October as being sort of an inflection point on inflation. Like, even though the annual went up, it went, and I know people hate to use the word transitory, but if you wait long enough, I guess everything is transitory. This too shall pass. But I think that maybe the reason why the market reacted in the way it did is it's possible that there was an inflection point on inflation. Do you make anything of this data, Mike?
I think generally what it makes me think is that inflation is here,
Mm-hmm.
and it's going to stay until probably mid next year. That's my thought,
Mm-hmm.
especially based upon historical data that I've personally been through. One thing that about inflation that people have most investors have not been through is when inflation was running at near 20%. And I've lived through a 20% inflation. I've lived through house rates of 18% for a 30-year mortgage.
Mm-hmm.
So you have to think of it in perspective of the past. So yeah, this inflation is not welcomed by anybody, especially when you go to the gas pump and everything. However, the gas pump has started to trend down. And I think once the supply chain issues become resolved, I think you'll see this come down maybe a couple of points by midsummer.
Yeah, and I'm thinking that the market, the way it reacted on Friday, thinks that makes it look like this October might be our inflection point. And then, as we know, coming up this Wednesday, well, we got the Fed chief's going to talk. Well, Jerome Powell's going to talk about tapering and rate hikes and things of that nature. What are you expecting?
I expect him to be a little bit more hawkish. He's been dovish, but I think his hand is being forced politically, even though they're not supposed to be political. He's a human being, and he reads the papers and he gets emailed. And the issue of inflation is probably the number one thing politically in the country at this point. I think it's more politically charged than COVID and vaccinations.
Yeah, and but he was also the one that was in charge in 2018 when they started doing, I think it was 4 interest rate hikes in a very short amount of time, and there was a taper at that time, and it caused, he was very hawkish then, and it caused the stock market to dip, I want to say along the order of 20% in that time frame. And he happened to be the Fed chair at that time. Do you think that his experience with that might help with our current situation that we're going to have coming up here this Wednesday, relative to how the market might react to what he's going to say?
Yeah, I think his past experiences told him to be a little bit more cautious as you start to cause rates to rise. I don't think he's going to be quite as aggressive about raising rates, but he has to do something. He can't just sort of let it ride. That won't work in this political climate.
Yeah, so I just made up this little chart here while we're just talking here, and I made up this little chart here for it's the economy, the taper, what's called QE, quantitative easing. So basically slowing down the purchase of government bonds. It looks like when the economy is up and inflation's really hot, then you want to do the taper down, and then bringing the taper down makes interest rates go up, and interest rates going up makes stocks go down. And that's kind of the situation that we're in right now. And I think people are kind of nervous about this one here, the stocks going down. But we have to do a little something to ease the inflation. So I have a feeling that his taper he is going to start tapering a little bit quicker than what people had thought. Well, at least what he's been advertising anyway. And I think that, like you said, it's politically motivated. I think that basically it's with the Biden administration has more or less said we have to get this inflation down.
Right. Well, that's a big political issue right now, as Biden's ratings have been dropping as the inflation has been going up. So they're inversely correlated. So one of my thoughts is that because this is going to happen, I mean, it's probably 90% probability it's going to happen, that when you buy stocks, you have to think about which stocks will benefit from this and which ones won't. Companies that have to borrow money will not benefit. They'll start to drop. Companies that don't require money, borrowing money like Apple like
Mhm.
Microsoft, like Google, those companies will do well. Also, those companies that don't have real supply chain issues, such as companies that are in the cloud, uh, hybrids like Microsoft, which is in the cloud, plus it has all the software business, will do very well. And that's one of the reasons Apple is doing well right now. Apple's had the best 2 weeks it's had, or 4 weeks it's had in the last 12 months, just in this period of times in terms of percentage up,
Mhm.
because it is flush with cash. Also, the companies that are not only flush with cash, but are buying back their own shares, that have enough money to buy their shares, are going to do well, like Oracle just did, like Broadcom just did. So those are my thoughts about that.
Yeah, and like you said, companies that have to borrow money in a high interest rate period, that's not a very strong company. And also the company that at least strong through these types of times, and also the ones that are depending on during high inflation times, companies that are depending on money that they're not expecting to receive for 5 years. Well, they're borrowing money today, and in 5 years they expect that what their return is going to be is less than what they're borrowing today. Like these companies that have no revenue at the moment, but they're banking on future revenue or future growth or future net earnings or whatever, that those earnings are somehow dulled by high inflation.
Right.
Um, so with that as the backdrop,
That's one of the reasons a lot of the high flyers of the pandemic, in my opinion, are falling. Some have fallen 50% in the last six months. Some have fallen 30 and 40% in the last 8 weeks.
do you think they can rebound before the end of the year?
Those, no.
No, you think they're those high flyers are done for the forward for the like the time being?
Yeah. To me, the analogy is like a big freight train that put on the brakes and it continues to skid until it either comes to a stop or hits something. Um, and so I don't think those companies are going to all of a sudden turn around and go up. What's been going up and will continue to go up are those that are paying a dividend, those that people know well, like the Home Depots and the Lowe's and the American Expresses. Those are the companies that are going to really benefit from this, because the perception is that they don't need to borrow that kind of money and that they have the floor of a dividend and they are well known.
So how do you think the financials react in these types of times where people aren't, when they don't lend out as much money because the interest rates are higher, but at the same time the interest rates are higher, so that which they do lend, they get more return on. How do the banks usually fare in these sorts of environments?
I think the banks that are well heeled, like the JP Morgans and Morgan Stanleys, should do well. They may not do well right at the beginning. They tend to sort of fall during the beginning of this because of uncertainty on which direction they're going to go. Is the interest rate really going to go up, or is it going to just stay up for a little bit? Is it going to flatten out? Is it going to come back down? So they wait to really get a feel for where the market's going before they start to benefit from it. If the rates stay up and continue to go up, they will do very well. But if the rates fluctuate up and down and the uncertainty is there, it may sort of freeze them from making a big move up or down.
Yeah, and I know that the smart money, right now during inflation would say go into consumer staples, utilities, ETFs, index funds, and things of that nature. But I'm a bit more of an aggressive investor, and this might come back to bite me, and it might not. But I tend to just try and pick winners. But it might be in this environment to just try and pick non-losers. And so I don't know what you're going to be doing going forward. Do you have any plans going forward? Like,
my plan is that I'm not going to buy any of the pandemic winners until they have stabilized for at least 4 to 6 weeks, stopped falling, like a PayPal. I'd love to buy PayPal, but I don't want to buy it when it's unstable like it is now. Square is another one. A good example of what could happen to you is look at Peloton. Peloton was $175 at one point in the last year, and now it's below 40, I believe. And so you have companies that are high flyers that need time to reinvent themselves now that we're coming out of the pandemic. I think by midsummer 2022, that the supply chain issue will be almost behind us. Companies will start to grow again. People will feel more comfortable about their jobs and where we're going. There won't be a lockdown. Hopefully there'll be more people either vaccinated or have boosters, and we'll probably get closer and closer to herd immunity as that 30% of the population that doesn't want a vaccine gets COVID, especially now that Omicron is here and Delta is raging out there.
Yeah, so I one of the pandemic winners I'm still sticking with, and better for worse, we'll see what happens, is I still like DocuSign. I think that it's a pandemic winner, but I think it's one of those that's here to stay. But I also think that there's another leg up for these crazy growth stocks, at least before the middle of January. I think we're going to see a run on them. I guess your wood stocks, if you will. So here's what we got coming up next week for earnings. Can you see that there, Mike?
Yep. Yeah.
So it looks like,
yeah, I've got that list. Yeah.
You got that list there?
Yep.
Yeah. So let's start the Wednesday off. So that's the same day that Chair Powell speaks, and that's an unfortunate day that Lennar gets to do their earnings call is going to be on that day. When I look at Lennar, I don't necessarily like the setup for this. I think that their earnings call will be great, but you can see, man, they've really run. They've gone from 104 just a couple of weeks ago all the way up to 116. Fundamentally, they're great. I mean, a forward PE of 8, and which is smaller than their current trailing 12-month PE. So that they're expected still to grow. But I just don't like this setup. I prefer if it was coming down first and then come in. Plus, I think that Chair Powell is going to come in and he's going to talk about raising interest rates, which can't be good for home buying. I don't know. I don't like the setup here. Are you playing Lennar at all?
I have Lennar. I have both Toll Brothers and Lennar, but I would not buy until you see the reaction of the earnings and the Fed, because they are affected by rates, of course, buying 30-year loans, and they're affected in another way. They have to buy land to build, and they have to have buy materials to build. So there are a few important factors for them. So I would wait to buy Lennar, and that's my plan. My plan is if Lennar seems to hold up through all this, then I would probably buy a little bit. But if I'm expecting Lennar to fall, actually.
Me too. I'm staying well away from that. I won't be selling puts. I won't be buying and selling covered calls, nothing like that. I expect it to fall a few dollars. FedEx also.
On Lennar, you have to remember the Lennar was $91 the 1st of October. So from 91 to 117, and it's almost at its 52-week high now.
Yeah. I mean, it's setting up, no matter what they say, it's not going to be good enough, especially after when Chair Powell is talking. And then
it's a good company, but I'd wait to buy it. And same story for Toll Brothers, which recently reported. And I would just hang on to these and see how rates affect them.
Another one reporting this week is going to be FedEx. If FedEx looks like it's trending downward, and actually it's kind of hitting a resistance line. It's getting a series of lower highs and lower lows. This is not a good looking chart at all. It's very ugly. It's trading at a reasonable valuation. I mean, 13 with a forward PE of 11. You have to like the valuation. Now, this might be one that, even though it's trending upwards here, it might be one that might actually do well on earnings. Are you going? Do you own FedEx, or are you?
I don't like FedEx at this point. I don't like the chart. It has international exposure, and that's not good for it. I'd rather go with UPS. And if you look at the chart for FedEx over 5 years, you'll see that at the beginning of the pandemic, it was in the 120 range in March 2020, and now it's at 246. So it's made a big run from the beginning of the pandemic. And in 2019, it was trending down from 2018. It was at basically the price of FedEx today is what it was in 2018. So that's not a good chart. I think I would pass on FedEx. Let's see it prove that it can really start making money, and it does have international exposure, which UPS doesn't.
Yeah, I mean, this is an ugly chart. This is one I'm going to stay well away from. Even though I love the valuation, there's no reason why this should be happening. But like I say, the market's not always rational, is it? But UPS, I don't know. I was trying to see when they reported earnings here. I'm not seeing it. Maybe they're next week, but it doesn't really say. Let me just see here.
On the 16th, I believe.
Oh, so they do report this week.
They do report on the 16th.
Oh, well, that's interesting. Okay, so let me look at that one, because that one I'd be a lot more interested. I'm on your team when it comes to UPS, and the reason why is one, their chart is nicer, but look at this. Their PE is, their trailing 12 months is 28, and their forward is 17. They're expecting a hell of a lot more growth than FedEx is.
They will mirror the growth in our economy coming out of the pandemic and coming out of supply chain disruption. They will benefit much more than FedEx because, again, they're not an international person. They're total US. Wow.
And they're bouncing off their 20-day. And they've got resistance at about 219, 220. 220 is their resistance. You know something, this is probably going to be one I enter into. This is when I like the setup. I'll probably get into this. I'll sell a put of, let's go with here. I'll sell a put for 188 put. I'll sell if I can get it for that. I might have to do a 190. So I'll sell a put for 190. I'll sell a covered call for 225 because I'd like to get all of this I could. So this would probably be one like the Lululemon trade of last week. I'll probably get into this one. I don't think it would fall down here. This is just like, to me, this is free money. If somebody wants to give it to me, great, I'll take it. And then, but I am going to be cautious because you said it's the 16th. Chair Powell talks on the 15th. So I'm going to wait until after he's done his thing to see how far this falls before I start buying anything and selling options on it. But this is one I'm definitely interested in. Rivian, I'll go ahead and let the cat out of the bag. I think their earnings are going to be 0. So we'll get that one out of the way.
Yeah, their earnings are going to be 0.
Yeah, so I think we know what Rivian's going to do. So there's Adobe. Now this is the big one. This is the one that everybody's probably waiting on.
Yeah. It reports on the 16th.
Yeah, the same day as UPS. Although I'm going to not be in Adobe. I think I'm going to go UPS instead. I think it's easier money. This one's a wild card here. It trades a very rich valuation, similar to Lulu. I wonder what its margins are. I know the market loves margins. Let me go to Adobe and see what their
Mike, you know that UPS doesn't report until February, so.
Oh, they already reported.
Yeah.
Oh, okay. Never mind then. Never mind then. That would explain their bump up here recently, because they reported. Got it.
Yeah, Adobe to me is a premier great company. If you look at its 5-year chart, it's been on trend for that whole 5 years. It's had dips when the market had dips. 5 years ago, it was trading at about $102, and now at $654. It has even a better trend line than Costco, but it's more volatile than Costco when the market goes down. And it's had a couple of those hits. In September, it was 577 on the end of September when all the market took a hit. Now it's 654, but it's been as high as 699. So it's close to its all-time high of 5 years. So as you know, its PE ratio is about 54. It doesn't have a problem with money. what it has a problem with is perception that it's high tech. And
The other problem that I have with them is what happened to DocuSign, which is a very similar type of company. Not the DocuSign doesn't make money yet, but they will next quarter. But it scares me now. Now, when I look at Adobe, they used to be a really fast growing company. We're looking at about 50% this year, and then down to about 30%, and then down to about 20%. And now down to even less. You know, they're growing less and less every year. Their net income after taxes 52 billion or 5.2 billion. So they're about 40% of all the money they make is profit. So that's absolutely fantastic. Their bottom line is rock solid. The setup for that stock, it looks like we've come down from highs. It looks like it's traded around the 694 mark, but I just don't know what kind of earnings it would have to report to send it much higher. Like I like it, huh?
I think it's going to go down. I don't think the market's going to be happy enough with the earnings, and it's coming into kind of still the sting that happened to NASDAQ last week and the week before. So I think I would wait for it to report. Wait to see how Powell's affected, and I'd probably give it quite a bit of leeway before I'd back into it at this point, even though it's a great company and it's made a lot of money. You know, the floor for it might be like even all the way down to the 610 level.
I'm thinking 550 even.
Yeah, I mean, you know, I would just wait. Great company, but wait to see what happens.
Yeah, the $550 put here to sell, because I was looking to see if I could sell a put on Adobe way out of the money and see if I get some money out of it. Looks like for 550, I'm only getting $120 total. I don't think I need to tie up that much leverage just to make 120 bucks. Let's see what the market thinks of it going down to 600. Okay, I get 450 for that. I'm kind of looking for $1,000.
Well, if you look at
I had to go down to 630. You know,
yeah.
630 is, I would not touch that. Because that is an area of support here. It looks like about 630 right there.
Yeah.
It looks to be like an area of support. I just would not touch that because I think they can easily go below that.
Yeah. Well, in October, it was the 560 level. So it's already almost $100 a share higher than October. So I just think that if you look at the trend from beginning of October to now, it's been kind of flat and it's been bouncing up and down, a little bit trending down. So I'd wait.
Yeah.
Great company, but I would wait.
Yeah. So I think that they could come down and then about 550 there, it'd be a good place to come into it, to start buying some Adobe.
Yeah.
All right. And then let's see, let's go ahead and we can wrap this up. And I do want to talk about one thing real quick, if we could. And I have an interest in this Lucid Motors. And what Lucid did was Lucid stock was lower by 1.7, was traded way lower after this convertible note offering. And then when I look at this, what a convertible note is, it looks like the convertible note is a senior convertible note is a debt security that contains an option in which the note will be converted into a predefined amount of issuer shares. So it looks like they're offering somebody $1.75 billion of notes that could be converted into issuer shares. I don't know if that means like printing more shares. Is that what that means?
Yeah.
Yeah. So
it's going to dilute earnings.
So it's quite diluted, and it already trades pretty rich, and then it's going to be diluted. Yeah, so I think that this article here, a new investment opportunity just arrived, just because the stock went down a ton. I think what we're doing is we're talking about diluting the hell out of an already rich stock. So that might be one I'm probably going to steer well away from. And then one that I was looking at here was this an IPO coming up. It's the IPO for Mobileye. I guess they're going to spin off of Intel, because basically the Mobileye unit of Intel is going to spin off in the second quarter of next year, is planned for the middle of next year, and it'll be the planned at $50 billion, which, as I understand it, is $52 a share. And that's coming next year. And Mobileye's customers are, they partner with BMW, Ford, NIO, Nissan, Volkswagen, and Willer. They're not a pre-revenue company. They actually, oh gosh, I got to sign into Barron's to get this, but they actually made about $340 million last year. So they're not a pre-revenue company. Intel will still maintain a good portion of the stock of the company. Let's see, Intel will get, what do I see here? Intel will maintain like control over the stock, at least some part of it. I'm trying to find and see exactly how much. I don't have it here. But anyway, it looks to me Mobileye would be something I would be interested in getting into as a play. I have a feeling when it comes to market, it's not going to be $52 a share. It's going to be considerably higher.
Yeah, I think it's a great company, has great technology. It provides some of that autonomous driving stuff. I know my EV car has Mobileye.
Yeah.
It's a growth company, but you have to probably wait until it becomes not a IPO speculation.
Yeah, and they actually use LiDAR technology to guide your car with the autonomous driving. And so some of the LiDAR companies might become better, like might go up in price as well. Luminar or maybe Microvision or something like that might go up. I know that Tesla does not use Mobileye because they don't like the idea of mapping. I guess Mobileye uses maps, so like Google Maps to know where they're going. And Tesla is more of the opinion that we don't work off of maps, do humans. We look around at our surroundings and go from there. So they're not going to use Mobileye. They're going to use some sort of more advanced sort of AI type of thing. They're not going to work off of mapping. But still, I think that Mobileye, because it does make revenue, it's a good company to take a peek at. Now, before we go, do you have a stock that you're going to be buying this week coming up? Do you have any recommendations for yourself this week coming up?
I might buy more Costco, and I might buy more Microsoft, depending on how the market acts. I think those are great companies.
Yeah, and for me, I'm going to be, I expect NVIDIA to take a hit, a really big hit on Monday or Tuesday or Wednesday when all the other overpriced stocks take a beating. I expect that they're going to take a beating, and I'm looking really close at an NVIDIA in the 280 mark. I still own a bunch of NVIDIA, but I think that they could come down $25 a share between now and Wednesday. And at that point, I'm going to get in and buy a little bit more. So that's going to be my.
That's a good thought. I would do the same. I have NVIDIA like you, and my price point is in the low 200s. So yeah, I'd be willing to average into it if it came down to the 280 mark. But I'm agreeing with you. It probably will trend down.
And then and it was already previewed on Mad Money with Jim Cramer that he's going to be basically pumping Williams Sonoma. Williams Sonoma is well down from where it had been. They had a top line and bottom line beat here when they reported earnings a month ago. Top line beat of 3.5%, bottom line beat of 6.8%. And you can see that they've been trending down ever since. And this might be one ahead of Cramer's show. This might be one that I just do a quick turn on this week. I did for last week. Didn't make a ton, like $150. But that'd be one that I'm probably going to be just doing a quick turn. So I think for the long run, I'm going to probably pick up some more NVIDIA, and for a short swing, I'm going to pick up Williams Sonoma. That at least I got to figure out when Jim Cramer's going to talk about Sonoma on his show, but he's going to pump them, and that's going to be good for about $5 or $10 upwards.
Yeah, it's been at this kind of range, the 160, 175 for about 3 months. However, in the summer months, this past summer, it was in the 150 range. So it's moved pretty much from the 150s up to 175 since July. But it was as high as 218 about in mid-November. And so that's been a big correction from 218 to 175.
Yeah, it reported on the 17th. It ran up to 223. And after it reported, it had a top and bottom line beat and beat on guidance. And all it's done since then is come down $50 a share. And this 175 seems to be a pretty good area of support. So I think just for a quick turn, this might be one that I pick up fairly early in the week and then wait for Kramer to pump it and then dump it after like a 1% trailing stop or something like that after the Kramer show, or maybe even during the show. I'll go ahead and dump it just after he talks about.
He likes William Sonoma. He likes the CEO, and by the way, they also are Pottery Barn. If you didn't know that, a lot of people don't know that.
They're what?
Pottery Barn.
Oh, I didn't know that.
They have the furniture segment with Pottery Barn.
Mm-hmm. Yeah,
William Sonoma has, the pots and pans and eating utensils, but it also has the furniture component too.
Mm-hmm. Yeah, I bought them as a sympathy play for RH last week, and plus I like their valuation. And I like the fact that they were coming down, and I thought I could catch them. I think they're more of a rubber ball than a falling knife. They will go back up. But shoot, so those are my 2 plays this week. I'm gonna do Nvidia for the long haul. I'm probably gonna do a quick turn on William Sonoma here, and I think that's got a good area of support right where it's sitting right now. I like the price right where it is. So. All right, Mike. So listen, we're not financial advisors. We're just talking about what we're doing. Mike's going to pick up more Costco this week. I'm going to pick up some Nvidia on the decline, and probably William Sonoma on the turn. And that being said, well, I guess we'll see you next week. Have a good day.